Coming up today, stocks close lower, the latest earnings results from Tesla, Microsoft, and Meta, what Jay Powell doesn't know, and Trump ramps up his attacks on the Federal Reserve. It's another big day, guys. Let's go. And here we are in the post-market session, still trading. As I speak, we've just had earnings come out on a bunch of big companies. Tesla being one of them. They actually missed on the top and bottom line. Initially sold off, but we've bounced back up here. Currently up about 2.5% after hours as I speak. Microsoft came in with a slight beat. The market has sold them off, down almost 2%. And Meta is absolutely printing cash once again, coming in with a monster beat, 18.7%. Business still growing over 20%. Year over year is incredible. And more importantly, what I've been looking for today was reiteration of their huge CapEx spending on AI. We've heard that once again. Meta plans on spending hundreds of billions of dollars on AI over the coming years. They've already done over 50, and that's helping Nvidia to have a little bounce after hours as I speak as well, up over 2%. And there's a bird's eye view of earnings results for the largest companies today after close. Green across the board, only a couple of misses in there. Tesla did miss by 3 cents. And there's a look at their Q4. And so even though they missed on revenue and earnings, still yet to see big overall growth there again. We did get some good things. Cash flow positive, getting cash on their balance sheet above $33 billion. Reiterated plans for cheaper models on the way. And their energy generation and storage business still absolutely on fire here, up 113% year over year. That's incredible growth there, along with services as well, up 31%. Another important KPI, they got their average cost of making their vehicles down to an all-time low. And that's been steadily downtrending these last few years now, averaging just under $35,000 in their costs to make a vehicle. But I think why the market's rebounded is on those things as well, including the excitement for automation and full self-driving that's going to be rolled out in Europe and Asia, all around the world. Teslas now drive themselves from their birthplace at the factory to their designated loading dock lanes without any human intervention. And so autonomous vehicles, electric vehicles, robo-taxis, that's all the future. It's undeniable, it's certain, it's just a matter of when. And in my opinion, the game's already been won by Tesla, head and shoulders above everybody else. Not to mention Optimus Bot coming as well. And again, here's a bird's eye view. Look at their annual revenue, not only the exploding growth over the last 5 years, but the change of the makeup of their revenue. And what we can see is growth in their services and energy businesses. So the long-held argument by Tesla bears, with whom there's still plenty around, as they scream at us every year. It's hit the top, the bubble, it's gone too far. Their main argument is Tesla's just an overvalued automotive company because it's on a way higher multiple than General Motors, Ford, all the other legacy ICE makers coming out of Europe and Asia. The truth is Tesla is the #1 clean energy brand in the world. EVs is just one segment, and like Elon says, robots in the future will be bigger. Optimus will be a larger business than electric vehicles. And who knows what else they could get into to do with energy generation and storage as well. And so just going out to the daily chart on Tesla, currently trading 396 after hours, just under 400 here. We'll see where we open up tomorrow. Could see a bit of volatility, but overall just a slight miss on the top and bottom line. Nothing to freak out about, in my opinion. And for sure, at 1.2 trillion market cap, I'm not saying it's cheap. It's obviously still going to have a lot of volatility. I mean, just looking back over the last few months, we've got a high of 490 and a low down at 210 when I was last adding to my long-term position after their Cybercab presentation when it gapped down the next day. So this is always going to be a really volatile stock. However, I continue to believe it'll be 10 trillion plus market cap by 2040. Applying an average compounded yearly growth around 20%. And because it is Tesla, I don't think we're going to see a PE on it 30 or less anytime soon. Because if we did, that would represent a great buying opportunity in my opinion. But right now, I'm not adding any more shares to my long-term position. If we happen to dip below 300 this year, I may do so. But like I said, last time I added was in the low 200s, and I thought that was good value back then. And just like I told you guys back in mid-December as well, was really technically stretched there. 40% above the 50-day VWAP was a good place to trim and offload some shares when everyone's jumping over each other to get back into the stock like we always see with Tesla. Has some wild swings. Generally best to be on the other end of them. But anyway, it's a great stock and I plan on owning it forever. Just moving on to Microsoft. We just heard from them, their artificial intelligence business now does about 13 billion in annualized revenue. AI isn't just hype and stories. We are seeing real revenue from AI related products. Earnings per share, 323 versus 311, almost beat on revenue by about $1 billion. And man, just think of the size of that business, almost 70 billion just in the last quarter alone, as a global monster. Cloud still growing 19%, also getting rumors they may buy TikTok. And we also heard from them that CapEx soared in the latest quarter, up 96%. That's massive spending. And I still think we're in the midst of the biggest CapEx cycle in history. As the world transitions to being AI powered, along with robotics as well, we've got a long runway ahead of us. The Roaring 20s is looking great so far. Space, rockets, electric vehicles, now AI, robotics next, big advances in healthcare and disease among many other things as well. And there's a look at Microsoft's latest quarter. Good to see their legacy businesses, Microsoft 365, LinkedIn, still growing healthy, 14% year over year. And look at that gross margin, 69%. Nothing more profitable than running digital businesses. And there's a look at the daily chart. Microsoft currently trading around 433, right around the 50-day VWAP. Have been consolidating here quite a few months. Be interesting to see whether this resolves on the upside or downside. And moving on to the company with the best numbers out today, Meta. EPS 802 versus 677. Revenue coming in with a healthy beat as well. And just stepping back and looking at Meta's revenue growth over the last 10 years, incredible. 12.5 billion. Here we are, 162 billion. And so many people just look at the stock chart of Meta and think it's gone up so much it has to therefore have a big crash. What they don't realize is the business has exploded in that time as well. If these stocks are going to have a huge crash, then so does revenue. Otherwise, it sets up for a great buying opportunity. And like I said, what I was really looking for today is their commentary on CapEx. We anticipate our full year 25 CapEx will be in the range of 60 to 65 billion. That is massive. We expect CapEx growth in 25 will be driven by increased investment to support both our generative AI efforts and core business. There it is, straight from the horse's mouth. One of Nvidia's biggest customers reiterating plans on spending big this year. Just because that psyop out of China with DeepSeek that's got every online furu screaming the AI bubble's now popped because of some apparent $6 million knockoff of OpenAI. That narrative already doesn't appear to be holding up. Because no doubt, companies are going to get more efficient with what they can do with these chips. Doesn't mean they still don't want to outspend each other, have the most capability. Still need millions of chips for the world to transition to AGI. And so Meta had already been doing well these last couple of weeks. Market sniffed out this good result. Still rallying after hours, just breaking above $700 a share for the first time. Currently trading 705. This is in a really strong uptrend now, and no doubt going to be a really key player in future industries, especially virtual reality metaverse, which could be another big one. And again, just looking at my seasonality forecast indicator, a few of these stocks gone into really bullish seasonal periods. Looking back at average returns in this same period over the last 5 years, there's an old saying you have to lock Americans up to stop them from spending. And even then they still find a way, and that is true here again today. Diners flocking to Chili's, parent company Brinker. Same restaurant sales soar 31%, and apparently we're on the verge of a recession. Just don't tell the millions of Americans still going out to eat. There's a look at Brinker today, up 16%. Brand new all-time highs. The market had already been in a really strong, persistent uptrend going into earnings as well. Same deal with Starbucks. No lack of demand for a $7 coffee. It too catching a strong bid today. Market warming up to the turnaround story here. Up over 8% as the company beat on top and bottom lines, gave good guidance. And it's not just Brinker and Starbucks and mega cap tech. CEOs are really optimistic. They're really rallying around the new Trump admin. They're excited by new technologies. And in fact, mentions of optimistic or optimism on S&P 500 earnings calls, that just broke out to a brand new all-time high. CEOs are really optimistic by what's around the corner. And so far, year to date, month to date, S&P 500 is up about 2.6%. We're really looking for a positive January here. That typically correlates with a positive whole year. Just looking back in history. In fact, there was only 3 years over the last 65 years where January gave us a positive return, 66, 01, 94, and resulted in S&P 500 being down for the entire year. Most of the time when January's bad, so's the whole year. Otherwise, most of the time when January's positive, that correlates with a positive whole year return as well. And we can see that in the R2 reading, which is the coefficient of determination, 0.27, basically meaning there is a bit of positive correlation there. And since there's only 2 full trading days left in the month of January, it's highly likely it will come in with a positive result. I mean, it's more likely we're going to get a positive year. And we've just gone into the 3rd year of this bull market. And typically when bull markets can last 3 years, they can go a lot further. If this bull market ended this year, it'd be one of the youngest. And looking back in history, one of the longest bull markets we've ever seen in history was thanks to the internet boom, PCs, computers. So we may not even be halfway through the AI robotics boom. And if we are you invested accordingly for that? And how is your portfolio set to benefit if this secular bull market still has many years left in it? I think a lot of people out there more concerned with their downside risk than their upside risk. However, we're still going to see plenty of bumps in the road like we have done lately. Nvidia starting to turn into a bit of a political football. Trump now discussing tighter curbs on Nvidia China sales after the CCP released the DeepSeek model on the same day of Trump's inauguration, sending a pretty clear and obvious signal shot across his bow. Looking almost certain DeepSeek did get their hands on some advanced Nvidia chips, most likely via Singapore, where Nvidia's been seeing booming sales lately. Don't think that's no coincidence either. The new admin's going to continue the Biden admin's objective of halting China's advancement, at least not helping to sponsor it. And OpenAI has already come out and said they have evidence that DeepSeek used its model to train its competitor. Don't think that's really any shocking surprise. It's Chinese culture to copy. What we think is dodgy, cheating, underhanded, they see as savvy, clever. It's part of their culture. They've been doing it for a long time, copying American IP. So no doubt they've done the same here. This is typically what they do in a lot of industries. They'll invite what they think is the leader in the industry to operate in their country, example Tesla, then they'll just copy everything they do. You'll see this time and time again. However, not everybody got shaken out. Former Intel CEO Pat Gelsinger, he bought the dip on Nvidia, saying the market reaction is wrong. Lowering the cost of AI will expand the market. Today I'm an Nvidia and AI stock buyer and happy to benefit from lower prices. And that coming from a guy who's been in the industry most of his life, really understands the business and market well, is a pretty good endorsement of Nvidia in my opinion. When Intel is pretty much a shadow of its former self, market cap 85 billion. Who would have thought 10 years ago, when Nvidia was a fraction of Intel's size, that here in 2025 Nvidia would literally be worth 40 times more than Intel? How markets can drastically change over the long term. But no surprise to see Nvidia trade down today a bit in regular trading, although we are getting a pop here on Meta's CapEx reiteration. No doubt this stock is going to remain volatile for some time. Questions around CapEx, China, and whether the boom in the phase one picks and shovel of the AI bull may be de-accelerating somewhat. And just moving on from earnings to the most other important news we got today, we heard from Jay Powell, kept interest rates on hold as widely expected. And I think he honestly doesn't know whether they're on hold or not. They really are in a wait and see phase. Did change their Fed statement somewhat, removing the text. Inflation has made progress towards the committee's 2% objective, but remains somewhat elevated. New statement just reading, inflation remains somewhat elevated. So you got to think about, what does that imply? Is giving up on the 2% inflation goal? Maybe removing the hurdle to lower rates? Maybe we don't need to see inflation go down to 2%. But Jay Powell says, don't look into that too much. He's not trying to send a signal. Rather, he's just cleaning up some text for grammar purposes. He did say the economy is solid, unemployment has stabilized, but on a lot of other things, he said, I don't know quite a lot. Always walking a tight line, Jay Powell. He knows his actions are a big part of the systematic inflation we have. So long story short, he's still swing trading the data month to month. He really doesn't know where they're going to be even in a few months from now. Market still thinks they're going to be on hold till June, where we may get one more cut, possibly a second by Christmas, which would please Trump as what he wants. So oil is going to play a key role in that, keeping a lid on that. And of course, inflation, which we get PCE this Friday. Looking across the street, they expect headline come in 2.6% annualized and core 2.8. And there's a look at Trueflation. Actually been coming down this last month, currently tracking annualized rate 2.61. So that's a good sign at least. And yields did get a little bump up from Jay Powell, but pulled back somewhat. 2-year sitting around 420 and the 10-year still hovering around 450. So bond market didn't have a huge reaction. There wasn't any really new bombshells coming out of Jay other than adjusting his text towards inflation. And in terms of Trump, he said he's not going to comment on what Trump has said. Probably doing the right thing and not looking to start a tit for tat. Jay probably just wants to focus on the data and block out the political noise. However, that didn't seem to work last year. When some politicians like Elizabeth Warren demanded a big cut from him, which he delivered, Trump came out swinging this afternoon, called them out directly, saying they failed to stop the problem they created with inflation. Yes, he went there. And so that's the first time anyone with this much spotlight is directly calling out Jay Powell on inflation. He also said the Fed has done a terrible job on bank regulation and he's going to try and bring down costs himself, slashing regulation, reigniting American manufacturing. He also criticized the Fed for focusing on progressive ideals. If the Fed had spent less time on DEI, gender ideology, green energy, and fake climate change, inflation would have never been a problem. And so no doubt, controversial claims, depending on who you talk to, but it is interesting just following the Department of Government Efficiency, which has just been set up, headed up by Musk. Some of the stuff they've been finding is mind-blowing. I wonder how many American taxpayers know $45 million of their money went to DEI scholarships in Burma. It's a country with exploding debt, $37 trillion, funding some of the most outlandish things around the world, $520 million for consultant-driven ESG investments in Africa, $1.2 billion awards to undisclosed recipients. Musk has been saying they're uncovering huge amounts of corruption, billions and billions of dollars going all around the world on really loose projects with near zero visibility and accountability. We also get a look at GDP tomorrow. Goldman Sachs just lowered their forecast. They're thinking 1.8 annualized growth, bit below what economists are expecting, 2.6, and the Fed at about 2.3. So we'll see where that comes in at, whether that has effect on any bond yields. But the world still is in global easing cycle. ECB looking like they're going to cut today as their largest economy still struggling to grow. German government thinking their economy is going to grow 0.3% this year. It's really sad what the socialists have done to Europe over the last 20 years. Stifled innovation, economic growth, spikes in crime, becoming the dumping ground for the world's worst, completely relying on Russia for energy, giving away nuclear, still over-regulating and overtaxing everything they can. In my opinion, Europe needs a Trump and Musk to make them great again as well. But I won't be holding my breath too long on that one. Just looking at Tesla after hours doing well, up almost 5% now. At this stage, looking like the bears were wrong again. See how it opens tomorrow. Really impressive report on Meta. Like I said, it had been trading well going into earnings, up 2.3% after hours, and Microsoft still coming off somewhat here, down 4.4%. Overall, the Qs are holding up. It was a pretty strong buy the dip technical action there we got On the deep fake news, there's a look at Alibaba, still waiting on their earnings results. They traded up again a bit in today's regular session, quite stretched here in the short term. See how they trade again tomorrow. And just looking at the VIX, 16.5, still somewhat subdued here. Volatility term structure in a healthy contango curve. Volatility risk premium 2.8, that's pretty low. And just looking at my sector breadth table indicator, still a bit of a pullback here in the short term. Financials really holding up the best, but we've seen those defensive yielding sectors, staples, REITs and utilities had a bit more of a pullback this last month or so. But overall, the trends are still up across the board. Market's still in risk on mode. Just a bit of congestion here as we get through Q4 earnings. Otherwise, the numbers are coming in pretty good. And like I said, 2 more trading days of January. We're most likely going to have a positive January, which looking back in history should be setting us up for another positive year. Thanks very much for sticking with Click Capital. And if you haven't already, hit that subscribe button and I'll keep you updated every day after market close. Cheers.